Let's talk about tax avoidance, using the legal provisions within the tax code to minimize your liability. Think of it as a game where the government sets the rules. Your goal is to play the game as strategically as possible within those rules. Here are 10 powerful ways to legally minimize your tax burden, often referred to as invading or attacking your tax bill. If I were you, I'll save this video for later. 1. Maximize retirement account contributions. This is the cornerstone of tax planning for most people. How it works. Contributions to traditional 401ks and IRAs are often made with pre-tax dollars, reducing your taxable income for the year. The money then grows tax-deferred until retirement. Strategic invasion. If you're in the 24% tax bracket and contribute $10,000 to your 401k, you immediately save $2,400 in taxes. Max out your employer's plan, $23,000 for 2024, plus $7,500 catch-up if 50 plus, and an IRA, $7,000 for 2024, plus $1,000 catch-up before looking elsewhere. 2. Leverage a health savings account, HSA. This is the most tax-advantaged account available, a triple threat. How it works. If you have a high-deductible health plan, HDHP, you can contribute to an HSA. Contributions are tax-deductible, growth is tax-free, and withdrawals for qualified medical expenses are tax-free. Strategic invasion. Contribute the maximum, $4,150 for individual, $8,300 for family in 2024, plus $1,000 catch-up. Pay for current medical expenses out of pocket and let the HSA grow. After age 65, you can withdraw for any purpose without penalty, though it's taxable like an IRA if not for medical costs. 3. Harvest your investment losses. This is a tactical move for your taxable investment portfolio. How it works. You sell investments that are worth less than you paid for them to realize a capital loss. You can use these losses to offset capital gains and up to $3,000 of ordinary income each year. Strategic invasion. Use a tax loss harvesting service or do it manually near year-end. You can immediately reinvest the proceeds in a similar but not identical security to maintain your market exposure without violating the wash sale rule. 4. Structure your business for advantage. If you have side income or a business, your options explode. How it works. Operating as an S corporation or LLC can allow you to take a portion of your earnings as distributions, which are not subject to self-employment tax, 15.3%. You can also deduct legitimate business expenses, home office, vehicle, travel, equipment, and even a portion of your self-employed health insurance. Strategic invasion. Work with a CPA to ensure you are paying a reasonable salary from an S Corp while maximizing the tax-free benefits and deductions available to business owners. Number 5. Shift income to family members in lower tax brackets. This is a classic wealth transfer and tax-saving strategy. How it works. By gifting income-producing assets like stocks or fund shares to children or other family members in a lower tax bracket, the subsequent dividends and capital gains are taxed at their lower rate. Strategic invasion. This can be done using custodial accounts, UTMA, for minors, or by funding a 529 college savings plan, where earnings grow tax-free if used for qualified education expenses. 6. Donate appreciated assets instead of cash. This move is for the charitably inclined who have highly appreciated stocks. How it works. Instead of selling a stock and donating the cash, which would trigger capital gains tax, you donate the stock directly to a qualified charity. Strategic invasion. You get to deduct the full fair market value of the stock as a charitable contribution, and you completely avoid paying the capital gains tax on the appreciation. The charity, being tax-exempt, can sell it without paying tax. 7. Utilize a 1031 exchange for real estate. A powerful way to defer taxes indefinitely on investment property. How it works. When you sell an investment property, you can reinvest the proceeds into a like-kind property and defer all capital gains taxes. Strategic invasion. This allows your entire investment to continue growing tax-deferred. You can repeat this process across multiple properties throughout your life. The tax bill is only triggered when you finally sell for cash and do not reinvest. Number 8. Take advantage of tax credits, not just deductions. Credits are far more valuable than deductions. They are a dollar-for-dollar reduction of your tax bill. How it works. Common examples include the child tax credit, the Earned Income Tax Credit (EITC), the Savers Credit for retirement contributions, and education credits like the American Opportunity Tax Credit (AOTC). Strategic invasion: proactively structure your finances to qualify for these. For example, ensure you contribute enough to a retirement account to claim the Savers Credit or time education payments to maximize the AOTC. Number 9. Invest in opportunity zones. A more advanced strategy for those with significant capital gains. How it works: by reinvesting capital gains into a qualified opportunity fund, QOF, within 180 days, you can defer and potentially reduce the tax on the original gain. If held for 10 years, all appreciation on the new Opportunity Zone investment is completely tax-free. Strategic invasion. This is a long-term, high-risk, high-reward strategy that requires careful due diligence, but offers one of the few ways to eliminate capital gains tax on future growth. 10. Strategic charitable giving with a donor-advised fund, DF. A DF is like a charitable investment account. How it works: you contribute cash or appreciated assets to the DAF in 1 year and receive an immediate tax deduction for the full amount. You can then recommend grants from the fund to your favorite charities over time. Strategic invasion. This is perfect for bunching deductions. If you don't have enough deductions to itemize every year, you can bunch 2 or 3 years' worth of charitable contributions into one DAF donation in a single year. This allows you to itemize and get a large deduction that year, and take the standard deduction in the following off years. The expert's final word: invading your tax bill legally is a game of strategy, knowledge, and timing. The most critical step is the first one. Consult with a qualified CPA or tax advisor. They can help you implement these strategies in a way that is tailored to your specific financial situation, ensuring your invasion is not only successful, but also bulletproof. If you love videos like this, then follow us for more.